Hello everybody, and welcome to today's session of the APRM exam preparation course. In today's session, we will start looking at section A of the APRM syllabus, where we will specifically look at chapter 1 titled Risk Management, a Helicopter View. Now, chapter 1 may be considered as an introduction to the APRM syllabus and risk management, where we will be looking at 6 headings. And in today's video, we will be looking at the first heading titled, What is Risk? So when we want to talk about risk, usually risk is perceived as the losses, or generally speaking, bad news. So whenever we look at risk, we don't think positively of risk. We always think about the bad news. We always think about potential losses that could have incurred. And this terminology, we need to reconsider the definition of risk. So in order to understand what is risk, let us assume that we are considering the investment in shares. And we have 2 investment opportunities, so let's call them investment in shares of company A, or we can invest in the shares of company B. Now, hypothetically speaking, let us assume that both shares currently have a price of $200 per share. And based on our assessment, shares of A can go as high as $300, while it can go as low as $150. While if we look at the shares of company B, it can go as high as, let's say, hypothetically, $500, or it could go as low as $50. So when we want to ask ourselves which shares are riskier, A or B, if you notice that the variability of possible outcomes in shares A are lower than the variabilities that could occur in shares B. So looking at the distance between the lower side of $150 and the upper side of $300 for shares A, and we compare it with $50, the downside of investment in share B, and the $500, the upside of shares B, you will see that the distance in B, or to be more technical, the variability of shares B across its current price will be higher. And that is why we cannot say that risk only relates to losses anymore. And throughout the APRM syllabus, we need to forget about risk being equal to losses. In risk, we talk about basically the variability of possible outcomes, or the uncertainty of possible outcomes, or we talk about the volatility of possible outcomes. So when we look at these 3 terminologies, we say that the higher the variability of possible outcomes, or the higher the uncertainty of possible outcomes, or we talk about the higher volatility of possible outcomes, these 3 will indicate that there is higher level of risk. So risk refers to, as we can see in the notes, risk refers to the variability of possible outcomes, or the uncertainty of possible outcomes, and the volatility of possible outcomes. And we need to understand one key element is that risk does not increase or decrease depending on the size of the exposure. So we need to understand that the higher the variability, the higher the risk. The higher the uncertainty or volatility, the higher the risk. We cannot say that the larger the exposure, the higher the risk. And risks can be categorized into expected risks and we have unexpected risks. Now, what is the difference between expected risk and unexpected? So we say that risks are two types. We have those that are expected, and we have those risks that are unexpected. Now, as the name implies, expected risks are those risks that will occur under normal operating environment, while unexpected risks are the risks that occur during abnormal operations. So an example of expected risk is if we look at banks who are offering loans to their customers, then part of their portfolio or part of their loans will go into default. So when we talk about default risk, this is considered expected risk. Another example is if you want to invest in shares, there is possibility that the prices of the shares will come down, which, as we move along in the APRM syllabus, we refer to it as market risk. Or even a credit card provider. Credit card providers also consider theft of credit card as an expected risk, and that is why they have policies and procedures in place in order to look at the risks related to thefts of credit cards. Now, when it comes to expected risks, if you notice, if we have two clients, let's call them client A and client B. Both of them requested a loan, and the amount of the loan is the same. So we're talking about $10 million. They have the same maturity date. So let's say that loan A is for 7 years, while loan B is for 7 years as well. But we notice that the interest rate that the bank charges client A would be, let's say, 8%, while we are charging client B 5%. Now, the reason banks charged client A a higher interest rate than client B is because, based on the assessment of the bank has concluded that client A is riskier than client B. And accordingly, if the risk of client A is higher than the risk of client B, we would notice that the interest rate that the bank charges client A is higher than the interest rate that the client would charge client B. So what we are trying to say is that because expected risks can be predicted, we factor those risks into the pricing of the facilities. While on the other hand, examples of unexpected risks might include, if you are familiar with COVID-19 pandemic, the COVID-19 pandemic was in 2020. This had a lot of impact on the entire global market. So losses associated with COVID-19 or risks arising from COVID-19 are considered unexpected risks because no one could have predicted the consequences of COVID-19. Another example is if there are natural disasters. Losses or risks that could arise from natural disasters would be considered also unexpected risks because it is difficult to predict when a natural disaster will occur. Also, if there are unexpected war, for example, then this will also result in unexpected risks. Now, since unexpected risks are difficult to predict, so we refer to this as unpredictable, what can the bank do in order to mitigate the unexpected risks? Usually what the banks would do is that they will take sufficient capital in order to have a cushion or to absorb unexpected risks. And that is why usually banks during downturn, where they expect the market to go into recession or depression, they would increase their provisions. And the reason they are increasing the provisions is that banks expect some sort of unexpected risks. So accordingly, they will take higher provision so that they would have sufficient capital in order to make sure that the bank sustains during abnormal market conditions. Now, although unexpected risks are unpredictable, however, in order to determine the amount of capital or the provision that the bank requires against the unexpected risks, as we move along in the APRM syllabus, we will be looking at some tools such as value at risk or economic capital, which will be considered as part of probability distributions. So for the time being, I don't want you to bother much about the concept of VAR or economic capital or the PDs or the probability distribution, because we will be talking about them in details as we move along in the APRM syllabus. So what we have covered so far is the definition of risk, the difference between expected risks and unexpected risks. Now, we need to emphasize on one element in risk management, which is basically risk management. We need to understand that risk management is basically forward looking. That means when we want to assess the risks, we need to look at it from a forward-looking perspective. And that's why if we want to rely heavily on historical data, then in this case, our assessment will not be forward-looking, since you need to understand that whatever happened historically does not mean that it will recur in the future. Yes, when we want to analyze, for example, the credit risk of customers, we look at their financial statements, which is considered historical. However, we need to understand the following. When we analyze the financial statements from a historical perspective, that is to analyze trends of profitability, capital leverage, the asset management, and so on and so forth. However, we also need to have projections, which is basically the forward-looking information. Because I'm certain that you know of companies that historically they have been outstanding only so that in the future they have been bankrupt. And one of the most famous companies that changed the shape of risk management and accounting is Enron. So the point is, when it comes to risk management, you need to assess risk from a forward-looking perspective, and we should not rely heavily on historical data. As we move along in the APRM syllabus, since in risk management we talk about projections and no one can predict the future with 100% accuracy, we will be talking about two tools that will help us in the assessment of our projections, which are the scenario analysis and the stress testing. Again, just like the value at risk, economic capital, and probability distribution, we will be discussing scenario analysis and stress testing in details as we move along in the APRM syllabus. Now, one question that comes to mind is that, is risk a good thing or a bad thing? Because whenever we talk about risk, again, the idea of risk is that it is always negative news and we need to reduce our risks. However, you need to understand that there are organizations that are willing to take higher risk. And the reason they want to take higher risk is that they have a lot of confidence in the way that they are assessing risk. So building up years of experience and assessing the market or assessing the credit risk or the liquidity risks of the market will allow them to take additional amount of risk. And the second reason why some organizations and some banks are willing to take additional risk is that they have sufficient amount of capital to absorb any risk or potential risk that could have incurred. The third reason is that usually, but not always, the higher risk that the organizations are willing to take, it is basically to allow them to generate higher returns. So the higher the risk, the higher the return of the investment or the credit risk that we are taking. However, as we move along in chapter 1's sessions, we will see that the relationship between risk and return is not always as straightforward as it is shown here. One important element for a bank or an organization to take additional risk is that they need to make sure that they have clear communications to all the stakeholders of the bank. And this includes the shareholders, executive management, and of course the regulators as well. So we need to be clear as a bank, if we are willing to take additional risk, that we need to communicate to our shareholders, executive management and regulators what is our strategy that allows us to take additional risk. And we need to understand also that usually when it comes to risk management, we always think about calculations, we always think about statistical analysis. However, we need to be very clear when it comes to risk management that some risks cannot be quantified. So, for example, if we want to look at customer satisfaction, although there are statistical tools to look at customer satisfaction, however, this is not a clear quantitative methodology to assess the customer satisfaction. If we look at the brand value, this is another example of a risk that cannot be quantified. If you look at the reputation of an organization, this is again a third element of risk that is important, but we cannot have proper quantitative or analytical tool to properly assess the reputation of an organization. With this, we have concluded the first part of chapter 1, which was titled What is Risk? In the next video, we'll be looking at the second section of chapter 1, titled The Conflict of Risk and Return. Should you have any inquiries, please do not hesitate to reach out to us through our email or contact us directly through our website. And I look forward to seeing you on the next video.